This is Australia, a vast country with a landmass of 7.7 million square kilometers, making it the sixth largest nation by total area. Despite its size, it has a population of just 26 million. In 2011, while many nations were reeling from the global financial crisis, Australia's GDP grew by approximately 2.5%. The terms of trade reached their highest levels in a century, about 75% above the average of the preceding 100 years, with the mining sector contributing around 8.4% of GDP. Australia's economic golden age was upon us. However, every rose has its thorn. Despite having a higher GDP per capita than many countries, including the UK and Japan, Australia faces significant challenges. Issues such as housing affordability, taxation rules, and economic policies cast a long shadow on its economic success. This begs the question, is Australia still an advanced economy? You see, the term advanced economy is loosely used by the International Monetary Fund, or IMF, to describe countries that meet several key criteria: a high level of per capita income, a very advanced level of industry, a diverse export base, and a financial system that is well integrated into the global economy. Now, let's break this down for Australia. Firstly, when we talk about per capita income, Australia undoubtedly fits the bill. It's one of the wealthiest countries in the world. Next, consider the financial system. Australia's currency and banking system are widely respectable and stable. Despite being the 13th largest economy globally, it has the 7th most widely held currency. Through effective management, Australia has achieved a solid financial footing. However, things start to get interesting when we talk about exports. Almost 2/3 of its exports are resources like minerals, and another 18% comes from education and tourism. Now, if you're wondering how tourism and education count as exports, remember that exports track the flow of money. When tourists spend money in Australia or foreign students pay for education, money flows from their home countries to Australia in exchange for services, thus counting as exports. It's like when you pay a visit to a museum. You're buying an experience, not a physical product. Nonetheless, the COVID-19 pandemic changed everything. The fallout has drastically impacted these two crucial export sectors, as international travel has come to a near halt, eliminating tourists and exchange students. Even before the pandemic, there were issues in the education sector, with reports criticizing some Australian universities for awarding degrees to foreign students who might not have been proficient in English, driven by the desire for foreign dollars. But like they say, cutting corners can come back to bite you. And it really did bite Australia, because this practice tarnished the country's reputation as a prestigious education destination. Without international travel, these categories are currently not contributing to the economy. This leaves Australia heavily reliant on exporting natural resources and livestock. Picture a country whose exports are almost entirely raw materials and livestock. You're likely imagining a developing or even undeveloped nation, lacking the skills and infrastructure to offer more than what it digs up or grows. In terms of export diversity, Australia doesn't quite make the cut, at least not until tourism and education can bounce back. Even then, it's not exactly a well-diversified export base. We can all agree that one of the major risks is putting all your eggs in one basket. For Australia, that basket is iron ore. Iron ore is Australia's golden goose, but relying on it too much makes the country's currency, the Australian dollar, very jumpy in the international market. When iron ore prices go up, the Australian dollar goes up. When iron ore prices go down, the Australian dollar goes down. They move in sync like dance partners, and this dance has some serious consequences. Firstly, it makes doing business internationally risky for Australian companies and foreign investors. Let's say you're an Australian company dealing in Australian dollars. You decide to expand and set up operations overseas. You invest 20 million Australian dollars in a new factory. Business booms, and eventually, someone wants to buy your factory for 30 million US dollars. Sounds fantastic, right? Well, only in theory. You see, if the price of iron ore has doubled in that time, the value of the Australian dollar would also have doubled. When you convert that 30 million US dollars back to Australian dollars, you end up with only 15 million. What seems like a great deal turns into a huge loss. The same problem plagues foreign investors wanting to invest in Australia. This exchange rate volatility makes Australia less attractive, especially for tech investors who crave stability. Speaking of tech, Australia has the potential to be a tech hub, no doubt about it. Notwithstanding having a relatively small population, it has made significant contributions to technology. However, their track record in holding on to these innovations is dismal. Imagine baking a delicious cake and then letting your neighbor eat it all. Likewise, Australia pumps millions of dollars into groundbreaking tech only for a foreign company to swoop in and profit from it. The industrial sector, which should be thriving with all this innovation, is instead shrinking every year. They don't produce many goods with high added value through technological expertise. Instead, they export raw materials. It's like selling a golden goose for its feathers instead of the golden eggs it can lay. But if Australia has so much foreign investment, why isn't it helping? Well, the truth is that not all investments are created equal. Foreign direct investment means companies or individuals from other countries buy businesses, real estate, equipment, or intellectual properties in Australia, and they get to control them. This level of control can make people uneasy, especially when it involves vital industries. Contrast this with regular foreign investment, where investors buy shares in a company without having control. They don't get to dictate operations. This distinction is crucial because FDI gives foreign entities significant sway over important assets. A glaring example is the Chinese corporation's acquisition of a critical trade port in Darwin. This kind of deal grabs headlines and fuels concerns. It doesn't really matter much where this money comes from. The issues it causes remain the same. More than 30% of all foreign investments made in 2020 flowed into the mining industry. This sector is a vital part of Australia's export economy. However, these resources are ultimately finite. The more foreign investors profit from these mines, the less there is for the benefit of the nation's people. To put it into perspective, while mining made up a significant portion of Australia's exports and attracted substantial foreign investment, it didn't really contribute much to the domestic economy. To understand why, we need to talk about taxes. Australia has some of the highest taxes in the world. While the top marginal tax rate of 45% isn't outrageous, it kicks in very early. Australians start paying the top marginal tax rate on every dollar they earn over $180,000 per year. But don't feel too bad for Australians just yet. One of the reasons Australia is home to the second wealthiest group of people in the world is a tax strategy called negative gearing. This means that if you own a property that earns less in rent than it costs to maintain in mortgage repayments and upkeep, you can count the loss against your income. On the surface, this doesn't sound too great. Lose money just to avoid paying tax? Surely you'd be 60% better off just paying the 45% tax rate, right? Well, not necessarily. There are two major reasons why. The first involves a little accounting trick called non-cash deductions, essentially expenses that are incurred but not paid for in cash, known as depreciation. For instance, if you buy a house for $4 million in Melbourne, that value might consist of $2 million for the land and $2 million for the structure. While land doesn't depreciate, the house on it does. If you estimate that the house will last 20 years before needing a rebuild, you can expense $100,000 a year in depreciation. However, the interesting thing here is that depreciation is just accounting trickery. It doesn't actually cost them $100,000 per year, and those houses will likely last much longer than 20 years. You might be thinking, surely they have to sell their properties to access any of the capital gains. Again, not necessarily. You see, once the property values have appreciated enough, investors can take out a cash-out mortgage to get a lump sum of money if they need it. Even if they don't need the cash immediately, they can still use a cash-out mortgage to gather funds for another investment property. The tax system in Australia is so favorable to property investments that it's almost unavoidable for those with high incomes, unless you want to make your accountant very upset. Nevertheless, this favorable tax setup unfortunately makes housing quite unaffordable for regular workers, especially young professionals working in major cities with comparatively modest salaries. This situation, nonetheless, attracts a significant number of foreign investors, particularly from China. These investors are often looking for a secure place to park their money where they can own properties indefinitely, unlike in their home country, where land leases are capped at 70 years. Although this trend has slowed somewhat due to the coronavirus pandemic, many of these properties, once purchased, are unlikely to hit the market again for a very long time. This further diminishes the supply of housing available for average Australians. Despite the headlines about Australia's booming economy, the reality on the ground tells a different story. Taxation rules. housing affordability crises, and widening economic disparities paint a more complex picture. Why is it that while some Australians thrive, others struggle to make ends meet? To get the answers to these compelling questions, click the right side of your screen right now to watch our earlier video on why nobody wants to live in Australia anymore. Don't forget to hit that subscribe button, like this video, and share it with your friends and colleagues. Thank you for watching.